All right, y'all. I'm gonna go over auction market theory and the basics you need to know of it, and I'm gonna explain it real simple. You know, not using big words or big terminology that you can't understand like these other videos. So, yeah. So basically, auction market theory is price going from balance or accumulation to imbalance back to accumulation. So this stretch is imbalance, balance, imbalance, balance again. And if we come back to another balance and balance out again, come back up, reject, come back to balance. So price is either imbalance or seeking to find new balance. Okay. Good example, literally right here. Price is in a balance or accumulation, right? And this is where we'd use our volume profile. Okay. So this is a high volume node is a good indicator of balance. So this all right here is a balance. So what you could do is how most people trade is off extremes. But majority of the time, if you trade off an extreme inside a balance back to the other balance, the other extreme of the balance, it'll usually be choppy inside. So what you want to do is the best and fastest trades, or you want to wait for a break of the balance and catch it to the where it's seeking a new balance. So in this case, new balance would be here. See all this accumulation going on here? That's our new balance. And you see price accepted into the balance. Then we later rejected it. Okay, and then we create a new balance here. So it's pretty simple and self-explanatory. It's not really that hard. Volume high and volume low, that just contains 70%, or some people say it's actually 68 point something percent of fair value. That's where 68% of the range was mostly traded. That's why I'd say it's choppy when you trade from this extreme back inside to the other extreme. What you want to do is catch, like I said, break of the balance and take it to new balance. Okay. Also, so these are good levels, volume high and volume low, good support and resistance levels, as well as the POC. And the POC is the number one point where there was the most trading going on. So you do not want to trade around there because you will get chopped out. That's the main rule. You don't want to trade around the POC unless you're catching a break and retest of it. But for the most part, you don't want to trade around it because you will get chopped out. I'll go over some more examples of AMT for y'all. And you don't even have to draw out the volume profile. You could, after a while, you just see it with your bare eye, okay, with the naked eye. You see how price is in balance, imbalance, back to balance. Imbalance, balance, back, imbalance. This is balance, imbalance, imbalance. Okay. Do these levels. So some news here, but we'll use this as an example. What's price here? It's in balance, right? So we want to mark out our extremes or our shelves, correct? These are extremes, okay? So as you can literally see, market open we reject off the extreme. You could catch that longs to the POC. You could take it to the next extreme, right? And look, we break above. Now we use this old balance as support to go higher. Then it looks like a failed auction. Come back in. Then we break back above. See, we use that as support now, trying to find new balance. Okay, so these extremes of the balances, extremely important levels of support and resistance. And that's basically what auction market theory is and how people trade it. All right.